Welcome to our webinar about the common challenges facing traders. One of the first ones is trading analysis paralysis. So many traders get into an analysis mode that they never do end up trading, or they're not successful in their trading because they do so few trades because they're always having to go to more and more information to make a decision. The second common problem is constantly searching for the miracle entry system that has a high percentage of winners, and they think that it's the magic of being successful is in the entry system or how high a percent of winners. And that's from a lack of understanding about the market, because frankly every strategy has winning periods and periods where it loses. And it's because of the market modes. There are different market modes, and different strategies capitalize on those market modes. And no strategy can be successful in all of them. What are those market modes? Well, you have an uptrend that's steady, an uptrend that's volatile, a sideways movement that's steady, called consolidation, or a sideways move that's volatile, called choppy, or a downtrend that's steady, or a downtrend that's volatile. So understanding that, quit looking for the magic entry system that's all of a sudden going to make you have this incredibly high percentage of winners, because it doesn't exist. And understand the market modes and how to begin to trade them. One of the third one is poor quality trading tools, and we're going to cover that, as well as number 4, misunderstanding of position sizing, and number 5, lacking good risk management techniques. So let's start covering some of those. The one we're going to get into now is using poor quality trading tools. In this example, we're using a 30-bar look-back setting on all the examples below. Now this is quite a dramatic example because you had a big gap up on the E-mini Russell, and it kind of went sideways to up a little bit, and then a very powerful down move. Now most indicators have a real problem with that. As you can see, this is the simple moving average. It was way behind the market. It was basically saying, the market was going up, and then it was way behind the market as it came back. So here's the bottom. The SMA hit its bottom 26 bars after the fact. Now the exponential moving average is the yellow one. Again, it's more responsive than the smooth price, but you can see the EMA was 16 bars lagging. So that's still a huge lag, which if you're working with data that far behind, that's a problem. Now our smooth price is a proprietary tool, and again this is an extreme example, but you can see how much more responsive this smooth price is. It went up much faster, responded to the top, turned over quicker, came back down in a powerful move down. So it was basically showing you this whole time here it was headed to the downside. Now the bottom was 6 bars after the actual bottom of the market, even in this extreme example. Now one other thing I wanted to cover here is just how long it takes for this type of gap distortion to be the effect that it has on the market. That's our next thing that we want to look at here. So here we have a nice gap, this same one we're looking at another day, but a nice powerful gap to the upside. And if you're making trading decisions still based on gap distortions, that can be a real problem. Because as we showed, here's the EMA right here, the yellow. Look at that. It took over 2 hours on a 5-minute bar chart before the standard EMA was just about recovered from the gap distortion. Here is our EMA. We have a gapless version of a number of indicators because the problem with gaps distort things so badly. If you're making decisions on that information, you're trading the wrong way. I mean, this basically is saying you have a powerful up move on the SMA and the EMA. Well, this obviously isn't a powerful up move. The up move happened during the off hours, and it opened high. And since then, it really worked its way down and made a big, powerful down move. Now, even our smooth price, you can see, suffers from that same gap distortion, although it recovers much faster and is back on track. So we realized there was a problem with gap distortion, and we built a whole family of indicators that removes the gap. So here's our EMA. See, it's tracking right with the yellow EMA, and it's this brown line. On the open of the market, it immediately goes up right underneath the price. It goes sideways, similar to this pattern, and then it heads down. And you can see it takes clear to here before the non-removal of the gap distortion and the EMA with the removal of the gap come back together. So it takes quite a bit of time for that standard EMA to really get rid of all the distortion of the gap. But several hours, it's very distorted. Now, even better, look at our gapless smooth price. It was above the price to begin with. It still is above the price after the gap. It immediately shows the red, and basically that was the direction of the trade. So do you want to be making your trading decisions on gap distortions, or do you want to make it on valid indicators? We have 133 plus customized charting indicators. We have 7 customized charting show me indicators, and we have 38 plus customized gapless charting indicators. So some of our proprietary tools, 38 of them, all are gapless, where it removes those distortions so the traders have better information. We also have 29 plus customized radar screen scanning indicators. And these things make up over 76 toolbox support workspaces, with the common workspace having anywhere between 4 to 6 or 8 charts per workspace. And we have 57 automated strategy workspaces. So you can see that this is only going to be a small little sampling to give you an idea of what's available here.